Hello everyone and welcome to this session where we would be discussing the all important AS16 which is on borrowing cost. This is an important standard where you get questions directly from this standard as well as it comes along with AS10 PP as well in some cases for certain adjustments. So it's a little complicated, so we'll do that properly along with the questions as well. So let's first get a brief understanding on what this standard is, for which items is it covering and what is the logic of coming out with a standard like this. So first of all, this standard is applicable to something called as borrowing cost. Now, can you give me some example of a borrowing cost? The usual answer is interest. Now, interest, if I were to take a loan of let's say 100 crores on which 10% is the rate of interest, I have to pay 100 crores into 10%, that is equal to 10 crores each year. That is interest. Interest is a cost because you have borrowed money, so that is a borrowing cost. So we first need to understand what is the borrowing cost. Remember, interest is an example of borrowing cost. It is not the only borrowing cost. We will study what the borrowing cost is. So first is we need to figure out what is a borrowing cost. Maybe let us say to start with, let us say it is an interest. Now what do you do with the borrowing cost or what do you do with the interest cost? We said 10 crores is interest. Your entry is interest account debit to bank. Now interest is a nominal account. It is an expense and hence it will go to the P&L account. So your second entry ideally should be profit and loss account debit to interest and hence whatever is the interest cost will go to the P&L account. Okay, so that is the second point. Where should the interest be taken? Well, ideally it should be taken to the P&L account. However, AS16 over here comes up with an exception. It says that if the borrowing cost is attributable to a qualifying asset, then it should be capitalized. Now, why should it be capitalized? We will see. But before that, we need to figure out what is a qualifying asset. Now, second is understanding what is meant by qualifying asset. Simplistically, for the time being, we will say qualifying asset is an asset which necessarily or ordinarily takes a substantial period of time to be ready for its intended use. We will figure out what all of this means, but that is, you need to first figure out what is a borrowing cost, then what is a qualifying asset, and third, will interest for this qualifying asset always be capitalized? Well, the standard says it will be capitalized till the time it is ready for use. Like when you did AS6, AS10, we said that all the directly attributable expenses will be capitalized along with the cost of the asset till the time the asset is ready for use. In a similar way, here the standard says the borrowing cost will be capitalized till the time the asset is ready for use. So over here, the timing of capitalization, till when should you capitalize? So these are the three things that you will start with on a theory level, and then we go to the numerical aspects, which is pertaining to the sums, which is more important from an exam perspective. So first, let us figure out what is a qualifying asset. A qualifying asset is an asset which necessarily takes a substantial period of time to be ready for its intended use. Now over here, what do you mean over here? Important, it should ordinarily or necessarily take a substantial period of time. And second, what do you mean by a substantial period? Now the standard has mentioned that if nothing is available, then a time gap of greater than or equal to 12 months for the period of construction or for it to be getting ready for use is a substantial period of time. So if I were to take more than 12 months to construct an asset before I can actually use it, that is when I will say that this is a qualifying asset. Like for example, if I were to buy an under construction property, now this property I believe is going to take around 3 years to be ready, in which case is it a qualifying asset? Answer is yes. However, if I were to purchase a ready to move in house is already constructed, it is ready, I make the payment, they give me the keys and I can start staying. So is this house a qualifying asset? The answer is no, because you are acquiring an asset which is already ready for use. So those assets which are under construction and which will take, let us say, a substantial period of time, currently we can say more than or equal to 12 months can be taken as qualifying assets. However, is 12 months a necessary condition? The standard says no. It is 12 months or the time period as specified by the company, whichever is relevant. So if nothing is specified, I will take 12 months. However, if I am a technology company, for me, I would say that technology changes very fast, and hence if a software even takes more than 6 months to develop, it is a substantial period for me, and hence I have decided that for the purpose of AS16, 6 months is my threshold for determining whether it is a qualifying asset or not. So if I am developing a software which is taking 8 months, that is a software which is a qualifying asset because it takes more than 6 months. That is a substantial period of time for me. Okay, so if nothing is given from a student standpoint, we can take 12 months, but if a specific time period is given, we will take that for the purpose of determination of a qualifying asset. So that is regarding the substantial period. Second, the asset has to ordinarily, that is necessarily, take a substantial period of time. What does it mean? Let us say my asset ordinarily, let's say my threshold over here is 12 months. My asset ordinarily takes around 6 months only. However, I have acted in a very lazy and a lethargic way and I took around 15 months to construct this asset. Does that mean this asset becomes a qualifying asset? Answer is no. Why? Because the asset ordinarily takes only 6 months. You took 15 months, that does not make it a qualifying asset. The asset should normally, necessarily, ordinarily take a substantial period of time. Or in the second case, let's say the asset ordinarily takes 15 months. However, I employed the best technology, made my workers work in double shifts and somehow got this asset ready for use in 8 months. Is it still a qualifying asset? Answer is yes, because it ordinarily takes more than 12 months. By the way, you got it done in 8 months, still it is a qualifying asset because it ordinarily takes more than 12 months. And hence, for you to figure out whether it is a qualifying asset or not, the asset should ordinarily, that is normally, take more than 12 months to be ready for its intended use. Now, the heading over here is qualifying assets, which means can they be tangible assets? Yes. Can they also be intangible assets? Well, why not? So if there's a software which is taking, let us say, 15 months to be ready for its intended use, that is still a qualifying asset, a software under development. And hence, if I don't have money and if I borrowed money to develop that software, the borrowing cost can be capitalized even with an intangible or even with a tangible asset. Now, a student typically thinks that a qualifying asset is usually a tangible, let's say an AS10 PP, or an intangible, an AS26, intangible under development. However, this is qualifying assets, which means even if there is something like an inventory, if this inventory takes a substantial period of time to be ready for its intended use, then even inventory can be taken as a qualifying asset. Like for example, if I'm a builder and I'm constructing buildings, inventory for me is flats, the buildings which is taking 3 or 4 years. These flats are qualifying assets for me. Or I'm like Bharti Shipyard or ABG Shipyard who is making ships. A ship is inventory for me, but to make the ship, it will take around 3 or 4 years. So these ships are qualifying assets because they are taking a substantial period of time to be ready for their intended use. So we are not restricting this qualifying asset only to a PP or to an intangible. Even inventories, if they take a substantial period of time, will be qualifying. But does every inventory take a substantial period of time? No. Maybe I'm in the business of manufacturing calculators like a Citizen or a Casio. It does not take a substantial period of time to make a calculator. Or if I'm in the business of making laptops or mobile phones, these inventories get ready for use in less than 12 months and hence they are not qualifying assets. So qualifying assets can be any assets, tangible, intangible, inventory, which is taking a substantial period of time to be ready for its intended use. Remember, if an asset is ready for intended use, immediately it is not a qualifying asset. Like I might purchase a ready to move in house, it is not a qualifying asset. I might purchase an under construction property which is taking 3 years, it is a qualifying asset. Now, institute may or may not ask you questions on this directly. However, there have been a lot of questions where what they do is they give you 5 or 6 items and then they give you total loan and interest on that loan, and they will say that, okay, figure out how much of this interest should be capitalized. We will say that, well, if this interest is pertaining to a qualifying asset which is taking more than 12 months, I will capitalize it. However, if I purchase a ready to move in house, it is already ready and hence it is not a qualifying asset. Interest will go to the P&L account. An important point over here is, what if it is a financial asset like an investment in shares, investment in bonds, debentures? These are investments in financial assets. I don't have money. I take a loan and I use that money to invest in shares. Now, can shares be qualifying asset? The answer is no. Why? Because the shares are ready. The moment you buy them, they come into your demat account. The shares are ready. It is like you are buying a house and you can stay in the house. Well, by the way, you might sell the house after 10 years, but the house is ready for use. In a similar way, you might sell the share after 10 years, but the share is ready. It is in your demat account, and hence financial assets like shares, debentures, etc. will not be qualifying assets, and hence if you are taking a loan for these investment in shares and debentures, it is not for a qualifying asset, no matter how much the institute tempts you with this. You will not take it as a qualifying asset. Like institute might say that I have taken a loan to invest in shares of my subsidiary. So be it. Let it be investment in subsidiary or any other company. It is not a qualifying asset. They will tempt you further. They will say, okay, this subsidiary has used the money to construct a qualifying asset. Well, good for the subsidiary. I am not doing accounting in the books of the subsidiary. Currently, I am doing accounting in the books of the parent who has taken the loan. Now, parent has taken a loan. In the books of the parent, I will see investment in the shares of the subsidiary. And investment in shares, these shares are there in my demat account. They are ready. And hence, no matter what the subsidiary does with the money, I will say that these shares are ready and hence they are not qualifying assets. So over here, we are saying qualifying can include tangible or intangible. They can also include inventory if it takes a substantial period of time. However, financial assets like investment in shares will never be qualifying assets because they are ready and cannot be taken as a qualifying asset. So over here, I hope you have understood what is meant by a qualifying asset. First thing. Okay. Second is borrowing cost. What is borrowing cost? We said a classic example of a borrowing cost is interest cost. Like I have taken a loan of 100 and on that I am paying a 10% interest. That is interest of 10, which is a borrowing cost. Now, what do I do with this 10? Well, usually I say interest account debit to bank 10 rupees and then P&L account debit to interest, that is 10 rupees. However, the standard says that if this interest or borrowing cost is incurred for a qualifying asset, I will be allowed to capitalize it only during the period of construction. Why? We will see that, but I will be allowed to capitalize. What is the meaning of capitalization? Which means interest account debit to bank 10 rupees and then asset account debit 10 rupees to interest. So I will add interest into the cost of the asset if it is a qualifying asset. So I hope you understand what is a qualifying asset. So as you can see over here, if your borrowing cost is incurred for a qualifying asset, then I will capitalize it. That is, I will capitalize it till the time qualifying asset is ready for use. And if it is incurred for anything other than a qualifying asset, I'll expense it to the P&L. What does it mean? Well, capitalize means interest account debit to bank and then asset account debit to interest. I will capitalize it and take it to the P&L would mean expense it. So P&L account debit to interest. Now, what is a borrowing cost? Remember, borrowing cost is a cost which is connected to the borrowing. Interest is connected to the borrowing. You have taken a loan and hence you have to pay interest. It is connected to the borrowing. But is that the only cost which is connected to the borrowing? No. Maybe instead of a regular loan, you have issued a debenture which is like a zero coupon bond or a zero coupon debenture. What happens over here is you are paying 0% interest. So by default, if you are paying 0% interest, I will say that the borrowing cost is 0. Well, probably interest cost is 0. However, in such a bond, what will happen is you will issue the bond at 60 rupees. And then you will tell the investor that I'm not going to pay you interest over the term, let's say 4 years, but at the end of 4 years, I will pay you 100 rupees. So usually when I borrow 60, I should repay 60. However, I'm repaying 100 rupees. That is, I'm repaying 40 rupees more. There is also a cost connected to the borrowing. I'm borrowing 60 and repaying 100. So 40 I'm paying in the 4th year. However, it is accruing, rising over the 4 years as a borrowing cost. This is called as amortization of discount. So there's a discount at which I'm raising the funds of 60 and I'm redeeming at 100. So 40 rupees of discount to be spread over, let us say 4 years, 10 rupees approximately each year is amortization of discount, which is also a cost connected to the borrowing. Had there be no borrowing, I don't have to pay 40 rupees more than what I'm receiving. I'm paying because I'm taking a borrowing. Alternatively, there can also be a premium where I take a loan of 100, pay some interest if applicable, and then say that I'll repay at the end 110 rupees. So the 10 rupees extra that I'm repaying is connected to the borrowing and hence premium or discount, which is arising along with the borrowing is also a borrowing cost. So your borrowing cost will include the interest cost, the most common, and then amortization of premium or discount is also connected to the borrowing, will also be a borrowing cost. The third one is there can be charges connected to the borrowing, like bankers can levy a processing fee or transaction charges. Now this processing fee or transaction charges are being paid because you took the borrowing. Another ancillary charge, whatever it is a cost connected to the borrowing, and as a result, these are ancillary charges which are like processing fees are also connected to the borrowing and hence will be treated as a borrowing cost. Now, these three are generally understandable. Point 4 and point 5 are linked to some other standards. Like point 4 is finance charges arising in case of a finance lease. If you have done AS 19, you would be aware of this. Otherwise, for the timing, you can keep it aside. By the time you do AS 19, you will be clear. What is a finance lease? As per AS 19, finance lease is a lease which is similar to borrow and buy, where substantial risks and rewards incidental to ownership are transferred to the lessee. In which case, I will record the asset and I will also record a lease liability on which every year interest will be levied. And that interest are also called as finance charges. As per AS 19, if you have done it, you will probably be able to grasp it. Otherwise, we will do it along with AS 19. So over here, this is finance charges in case of a finance lease, which is covered under, let us say, AS 19. There is also a type of a borrowing cost. Now, point number 5 is regarding exchange differences, some foreign exchange losses. Usually, you will study this along with AS 11. Now, foreign exchange losses as per AS 11 usually go to the P&L account. However, in certain cases, you can say that there is some borrowing cost element over here. We will do this probably later. We will first figure out general borrowing cost and then come to the specific adjustment. So if you go to the next page, this entire next page is pertaining to a few steps for this foreign exchange element. For the timing, I will keep that aside. I'll say I'll do it at the end of this video. But for the timing, let us just focus on the general borrowings. Okay, just focus on the general borrowing cost. So if there's any borrowing cost which is connected to the qualifying asset, you will capitalize the borrowing cost. Well, till when will I capitalize the borrowing cost? I have to look at the timing. Till when will I capitalize the borrowing cost? Only during the period the asset is being constructed. Now, over here, we will try to discuss why is this standard coming in the existence in the first place. Now, this standard is pertaining only to borrowing cost, and that too for those qualifying assets. Now, for constructing an asset, I can incur various costs like labor costs, material costs, production overheads. There's no standard for that. The law is very clear. You will capitalize material cost, labor cost, which is incurred for the purpose of constructing an asset, whether it is a qualifying or not a qualifying asset. I should always add it like I did for AS10. However, when I look at borrowing cost, if you have done costing and FM, the other subjects, you will know that borrowing cost is actually finance cost, not operating in nature, it is financing in nature. And if you have prepared cost sheet, there is no place in the cost sheet that is determination of cost for a finance cost. I will only take operating items in the cost sheet. So if this standard was not there, generally accepted cost accounting practices will tell you that material, labor, overheads, etc. are connected to construction, and hence it can be taken as a part of the cost or the cost sheet, but finance cost or interest cost will never be a part of the cost of the asset, and hence it will go to the P&L account. Like when you will study a chapter on reconciliation and costing, you will see that interest cost will always go in the P&L. It will not be a part of the cost sheet, and hence ideally interest cost should have gone to the P&L had this standard not been there. It was in any case going to P&L in general. However, for certain assets which are taking a substantial period of time, like I am constructing a nuclear plant, it takes around 5 years for me to construct that plant. For this nuclear plant, whatever is the interest cost incurred, this interest cost I would have taken generally to the P&L even during the period of construction, because it is financing in nature, not operating in nature. If I take it to the P&L, matching concept tells me that in those 5 years when this plant was being constructed, I am recording a cost, but corresponding to that there is no income. So matching concept is getting distorted not just for 1 to 3 months, but for a substantial period of time, because it is a qualifying asset, and hence the standard says I will keep aside generally accepted cost accounting practices which tell me not to include interest into the cost of the asset, and hence for better matching concept, I will allow interest for this qualifying asset to be capitalized. So what will happen is, for example, if I were to take a loan of 100 crores, use that money to construct a qualifying asset, it takes 2 years to construct. In the first year, 100 crores into 10%, 10 rupees is the interest. That 10 rupees will be added to the cost of the asset. 100 plus 10 will become 110. Another second year, you are again incurring 10 rupees of interest, will again be added to the cost of the asset. Asset becomes 120. Now the asset is ready for use. Now it will start generating income. So income will be coming from the third year. Whatever is the interest of the third year, 10 rupees will also go to the P&L. I will not capitalize even in AS10. Only those expenses at the time the asset was ready for use could be capitalized. Beyond that, every expense will go to the P&L. Same is the case over here. Beyond the asset being ready for its intended use, expense will go to the P&L account only. Now your asset will be at 120. In the first 2 years, nothing of finance cost went to the P&L. From the third year onwards, we started generating income, and your depreciation will be 120. Let's say the useful life is 10 years divided by 10, that is 12 per annum. So over here, you will be able to match. Ideally, your depreciation would have been 10 only, 100 divided by 10. Now it is going to be 12 rupees. So you are putting a higher cost, because in the first 2 years, you did not recognize this expense because there was no corresponding income. In the later years, you will record a higher expense, but then there will be corresponding income as well. So that is the logic behind AS16. If you understand AS16, if you understand this well and good. Otherwise, just remember that if the borrowing cost is incurred for a qualifying asset, then during the period of construction, you will capitalize the borrowing cost. After that, you will take it to the profit and loss account. Okay, so over here, we will try to figure out what we will do this page later regarding this foreign currency element. We'll figure out the timing of capitalization. When does capitalization start? Sir, capitalization starts usually when I take the loan. Achha, let us assume we are constructing a qualifying asset. The moment we take a loan, ideally interest ka meter chalu hota, and hence we will start capitalizing till the time the asset is ready for use. Loosely speaking, we will start capitalization the moment the interest cost is getting incurred, that is a loan is taken. And we will cease capitalization the moment the asset is ready for use, or substantially all activities to get the asset in the ready to use condition are completed. Now here there is some technicality. What can happen is, let us say in the year 2020, apne josh mein loan le liye. Now you took the loan, interest started, and then lockdown ho gaya, or forget lockdown, you started looking for properties. You thought that you will find a good property, but it was harder than you thought. For 1 full year, you looked at properties, you did not like any of them. But bank ko to aapko interest pay karna padega, you'll have to pay interest to the bank. Now comes a problem. You have paid interest for the entire year. Ideally, it is like a housing loan taken for a house, but you have not yet selected the house. The law would say that interest cost will be capitalized. Sir, kiske saath capitalize karenge? You can't capitalize interest along with a non-existent asset. You have not even identified an asset. How can you capitalize borrowing costs connected to that? And hence interest will go to the P&L till the date you identify the asset and acquire the asset. Like for example, the law will say you will look at commencement of capitalization from the date the loan is taken, or the date the expenditure is incurred. The moment you select a house, you buy the house, you will have to make the payment, maybe full payment, maybe part payment, down payment, whatever it is, but you will have to make the payment. And hence, the moment you incur that expenditure, we will believe that you have acquired, identified an asset, and hence the borrowing cost from that date can be capitalized. Before that, whatever cost you have incurred, it is not linked to construction of an asset. You have not even identified it, and hence only the borrowing cost from the commencement date, and commencement date is usually a date which is a later of the date when loan is taken or the date when expenditure is incurred, let us say whichever is later. So from the commencement date, borrowing cost, if any, can be capitalized. Now the problem is, generally the activities commence on constructing the asset the moment you spend money. So usually expenditure incurred and activities commence go hand in hand. However, let us say you want to construct a bungalow, you took a loan, you identified a contractor, you made them down payment, and the moment you made them a down payment, they started ghosting you, or they started ignoring you, they did not answer to your calls, reply to your messages, nothing. Now you can see in front of you that your bungalow, you have made the payment, loan was taken, but there's no work happening on the bungalow. Activities have not commenced. So how can you capitalize any item as bungalow under construction when the activities to construct the bungalow has not even started? So the standard tells you that commencement date will be the later of the date when the loan is taken or expenditure incurred or activities commence. After that, you can start capitalizing. So the commencement date over here will be the later of these three dates: loan taken, expenditure incurred, or activities to commence have constructed. Remember, activities can mean activities can very well mean even technical planning and site evaluation. It is not necessary that you should physically start constructing. Even if you are doing site planning, technical evaluation, that is also commencement of activities, that is fine. But activity should start. Once commencement date arrives, you can start capitalization. Till when can you capitalize? Well, once the asset is ready for use, or substantially all activities to get the asset in the ready to use condition are completed. So you have constructed the entire asset and you have submitted an application with the fire department, or let us say your municipality, to get an occupancy certificate. Now they are taking their own sweet time. However, your asset is constructed. Now till the time they give the approval, which is, let's say, a formality, a procedural matter, people can't come and stay. However, your activities are substantially over. So the standard generally says that the moment the asset is ready for use, that is substantially all activities to get your asset in the ready to use condition are completed, even if some minor administrative work is pending, you will stop capitalizing. Cessation of capitalization when substantially all activities to get the asset in the ready to use condition are completed. Now sometimes what might happen is the asset gets ready to use in parts. That is, let's say there's a project and there are 10 towers and these towers will be ready phase wise. Now if phase 1 is completed, let's say 2 towers are completed, you can very well stop capitalization on those 2 towers while you continue capitalization on the remaining towers which are still being constructed. So if your asset gets ready for use in parts, then you can cease capitalization pro rata, that is partially in parts as well. So this is regarding cessation. And then you have something called a suspension of capitalization. And cessation is permanent stoppage of capitalization because the asset is ready for use. Suspension is like temporary. So sometimes what might happen is active development on your project can be interrupted. You have started your work and then active development is interrupted for an extended period. For items which are abnormal, that is, they are not necessary to get your asset in the ready to use condition. Like for example, you started work on your project in 2018, your project was going to take 3 years. 2018 and 19 commencement of capitalization, you are doing the work in 2019 or 20 as a case, maybe COVID-19 comes in. And because of COVID-19, there is a lockdown and work is not happening for 6 months. But you have taken a loan, you have to pay interest to the bank even for those 6 months. But when you are paying interest, that interest is not contributing to constructing of the qualifying asset because no work is happening. And hence 6 months is a fairly long period, and hence we will say that the active development was interrupted for an extended period due to the lockdown. So for those 6 months, you will not capitalize interest, you will take it to the P&L account. Let's say an abnormal loss. And this is not an interruption which is necessary to get the asset in the ready to use condition. Sometimes what can happen is you will interrupt the work, but that is for normal factors. That is normal to get the asset in the ready to use condition. For example, when you look at roads which are made out of concrete, sometimes they put water in it and let the water dry out because that is when the concrete strengthens. Now at that point, there's no work happening. However, I will still continue capitalization because this interruption is necessary to get my asset in the ready to use condition. So suspension can happen if active development is interrupted, let us say for an extended period. Why? Sometimes you might have a Bharat Bandh or something for 1 or 2 days. Now materially tells you that yes, there is a Bharat Bandh of 1 or 2 days, so work is not happening. However, in a 2 and a 3 year project for 1 and 2 days to find how much is the interest, it's not material enough. So your stoppage should be extended. They have not defined what is extended, but anything more than 5 or 10% of the project life, if the interruption is happening, like a legal case is put in, there's a stay order and there's no work happening, that is an extended interruption, or a lockdown, extended interruption. due to abnormal factors which are beyond entity's control, like a lockdown. In that case, during the period when active development is interrupted, if you are incurring any borrowing costs, that will not be capitalized, that will be taken to the P&L account. So now this takes care, I think, of the third part as well, timing of capitalization. Remember, the moment the asset is ready for use, after that whatever is the borrowing cost will go to the P&L. So this is the theory section of the standard. After that we go to the numerical section. On the theory section, you need to know three things. First is what is borrowing cost, which can be interest, amortization of premium or discount, ancillary charges or processing fees, finance charges in case of a finance lease, and certain exchange differences which we will study. Second, what is a qualifying asset? An asset which necessarily takes a substantial period of time to be ready for its intended use, which can be more than 12 months unless anything else is given otherwise. And third, timing, we will say we will start capitalizing from the commencement date, that is the date when loan is taken, expenditure incurred or activities commenced, whichever is later, till the time the asset is ready for use, or substantially all activities to get the asset in the ready to use condition are completed. In the middle, if the work is stopped, interrupted due to abnormal factors for an extended period of time, then you will suspend capitalization during that time and you will take whatever is the relevant interest to the profit and loss account. Okay, so this kind of takes care of your theory section. Next, you go to the more important part in my understanding, that is specific and general borrowings, and actually finding out how much of the borrowing cost should be capitalized. Okay. So what do we mean by these borrowings? What do you mean by specific borrowings? Well, these are borrowings which are specifically taken for the purpose of acquisition of a qualifying asset. Like for example, if I were to buy an under construction property, which is a qualifying asset, for which I were to take a housing loan. Now this is a loan which is exclusively for the purpose of construction or acquisition of a qualifying asset, and it cannot be used for any other purpose. In such a case, this loan is called as a loan is called as a specific borrowing. Now, in case you are taking a specific borrowing, the interest cost for this specific borrowing is generally directly attributable to the qualifying asset only, and hence whatever is the actual borrowing cost from the commencement date. Remember, you might have taken the borrowing in 2020, but you found a good property in 2023. That is when the expenditure incurred, activities commenced. In which case, from 2023, that is the commencement date, whatever is the actual borrowing cost which is pertaining to this specific borrowing should be capitalized. Now, sometimes what might happen is you might take a borrowing of 100 rupees. However, you don't need 100 rupees immediately. You need only 40 rupees now and maybe 60 rupees after another 6 months. In which case, you'll spend 40 rupees for the qualifying asset, 60 rupees will be surplus with you, which you might invest, maybe in a bank fixed deposit, maybe in a bond, and earn some income. Typically, the standard is for borrowing cost and hence it does not cover income. However, generally, if nothing is given, income will go to the P&L. Now, the problem is if the income goes to the P&L, there is no corresponding cost going to the P&L for this, because the entire borrowing is for a qualifying asset and hence the borrowing cost is getting capitalized. So, here your matching concept is getting distorted. Your income is earned, which is going, let us say, to the P&L. However, the cost, this income is coming because I borrowed money and that money is still surplus, so that money is not coming free of cost. That money has a cost attached, and that cost attached is your borrowing cost, but the borrowing cost is getting capitalized. So how do I come out of this? The standard says whatever is the actual borrowing cost from the commencement date, you take that and then minus income on temporary investment from the surplus funds, and whatever is the addition, whatever is the net borrowing cost, that net borrowing cost will be capitalized. Or if it is not for a qualifying asset, the net borrowing cost will go to the P&L account. So whenever you have a specific borrowing and there are some surplus funds, you will earn some income on temporary investment of surplus funds. You will subtract that income from the overall borrowing cost, and the net borrowing cost, if any, will be capitalized. Remember, this standard only applies to borrowing cost, and hence if you have, let us say, questions where you have data like WACC, weighted average cost of capital, or a cost of equity, or a cost of preference share, these are not borrowings, and hence this will not be covered under AS 16 principles, and you will not account for the same as per AS 16. Okay, so this is capitalization for specific borrowings. Now, the most important section in my understanding is the capitalization of borrowing cost for a general borrowing. Now, over here what might happen is, let us say, if we take an example and understand it with the help of an example, there might be multiple borrowings in a company. There may be a specific borrowing, there may be a few general borrowings. Now, the problem is money is fungible. It is very difficult to figure out that if I am spending money behind a qualifying asset, from which source is that money coming, and hence the standard implicitly says that you will first assume that the money comes out of the specific borrowing. After the specific borrowing has been exhausted, we assume that the money comes out of the general borrowing. Now, the question is which general borrowing, if you have multiple general borrowings, in which case the standard says that we will assume a weighted average borrowing rate. So, you will take the actual borrowing cost of all the borrowings in the numerator, the total borrowings adjusted for time if required in the denominator, and that will give you a rate, a percentage per annum, which is a weighted average borrowing rate, and that weighted average borrowing rate will be applied on every rupee that is used from the general borrowings for the purpose of a qualifying asset. So there are a few steps. We will broadly review the steps, but more importantly, we will understand this with an example and use that for the purpose of our sums. First, you will look at expenditure. First you will look at borrowing cost from specific borrowings. That is your actual borrowing cost less income on temporary investment, if any. That amount has to be capitalized. Second, you will calculate the capitalization rate, also called as a weighted average borrowing rate, as the actual interest in the numerator divided by the total borrowings in a denominator. If the borrowings are not there for the entire year, then you might have to apply some time weights. Calculate the capitalization rate on a per annum basis. Third step, multiply the weighted average borrowing rate with the expenditure incurred out of general borrowings, that is after spending money from the specific borrowings, whatever is from the general borrowings into the time for which that money is used, divided by 12. So that will give you the eligible borrowing cost, which will ideally be capitalized. However, sometimes what might happen is your expenditure may be 100 crores, but your borrowings are only 60 crores, in which case your maximum amount that you can capitalize is your actual interest, because maybe the additional 40 crores is coming out of your own money. So you will compare the eligible borrowing cost with the actual borrowing cost and select whichever is lower. So generally your eligible borrowing cost will be capitalized provided you are incurring that much of borrowing cost. If you are not incurring that much of borrowing cost, then only the actual borrowing cost will be capitalized. So it's a very, you will review the steps, but best if you understand it with numbers. We'll take an example and then probably use that for the purpose of our sums as well. So over here, let us go to this example and then we'll go to the steps. There's a 12% specific loan taken on 1st April 10 for 40 crores. Income on temporary investment is 0.5 crores of these funds. There's a general borrowing of 10% taken on the beginning of the year, 15% borrowing taken on 30th September, and these are your, let us say, borrowing amounts. Expenditure is not incurred on the first day entirely. It's 30 crores, then 40 crores, and then 30 crores. That is a total of 100 crores. So what will we do? In step number 1, we will say calculate net borrowing cost arising out of specific borrowings. So there's a 12% loan, I think for 40, and hence if it is taken on the first day into 12 by 12, so this comes to possibly 4.8. However, there is some income on temporary investment of surplus funds of 0.5, and hence 4.3 is the net borrowing cost from the specific borrowings that you should be capitalizing. Second is you calculate the capitalization rate, weighted average borrowing rate for the general borrowing, where you will take the actual interest. The actual interest on a 10% loan for the entire year will be 10 crores, and for the 15% loan, this is 15% into 200, but this is for only 6 months, so 6 by 12. So this will come to, let us say, again, I think if I'm not wrong, 7.5. So this is 200 into 15%. No, this is 15, sorry. So this will come to 15. So your actual interest that you are incurring during the year is 25 rupees upon your borrowing. See, the borrowing of 100 is available for the entire 12 months. However, the borrowing of 200 is available only for the last 6 months. And hence this is 25 divided by 100 plus 100, which comes to, let us say, 25 divided by 200, and hence on an average this comes to 25 by 200. In percentage this comes to 12.5%. So this means on a per annum basis, for every rupee that comes out of the general borrowing pool, the cost is around 12.5%. So this comes to, let's say, 12.5% per annum. This is 4.3 crores. Okay. Third is there is expenditure incurred of 30 crores. However, this 30 crores must have entirely come out of the specific borrowing only, and hence none of this 30 is coming out of the general borrowing. Next, your expenditure on 30th September is of 40 crores, out of which 10 crores is still remaining of the specific borrowing, will come out of the specific borrowing, and hence the remaining will come, 30 will come out of the general borrowing, which is costing 12.5%, let us say, for 6 by 12. And lastly, the entire 30 is coming out of the general borrowing again into 3 by 12. So if I do this working, I will get possibly 30 into 12.5%, 1.875, and into 3 by 12, 0.9375. So this is 2.81. Now if you go to see, your total expenditure incurred is 100, out of which 40 goes from the specific borrowing, so 60 is from the general borrowing. Your total borrowing pool is 200 plus 100, that is 300 crores, and hence you have enough general borrowings to cover this. This can be seen by the fact that your actual interest is 25. So we are saying that out of actual borrowing cost on general borrowings, I think it is not 40 over here, this is 10 plus 15, that is equal to 25. So out of that, 2.81 will be capitalized. 4.3 plus 2.81, 7.11 will be capitalized. So this kind of takes care of the larger part of the theory, except for this foreign exchange adjustment, which we will discuss later. For AS16. Now, before you go to AS16 sums, a couple of things that I want to discuss. First of all, for most of these sums, institute gives you a single period problem, which means they don't go for 2 and 3 and 4 years, which means generally, if they don't go for 2 and 3 years, most of the times, whenever you are constructing an asset, institute assumes that it is a qualifying asset. Sometimes you might see that the asset is taking exactly 12 months, sometimes 11 and a half months. 11 months. So technically one can always argue that it is taking less than 12 months, and hence it should not be a qualifying asset in a numerical question. In a numerical question, institute always, if it is asking you to find the amount of interest to be capitalized, institute assumes that the asset must be a qualifying asset and hence solves it accordingly. In a case or a theory based question, yes, you may set to identify, but in a numerical question, usually assets that you are constructing are assumed to be qualifying, at least by the ICAI, unless otherwise given, and assets that you are purchasing, you might be purchasing a truck or a vehicle. Now, unless given otherwise, these assets are in the ready to use condition, they don't take a substantial period of time, and hence institute generally assumes that assets that you are constructing may be taking a substantial period of time and hence can be qualifying asset, but assets that you are purchasing are generally in the ready to use condition and hence not a qualifying asset. Also, items like working capital, maybe you raise money and some of that is for working capital, that is day-to-day affairs, that is not a qualifying asset. Or you may give some advance to someone, that is again not a qualifying asset. So you will see a lot of questions on similar lines that the institute asks. So the thumb rule that you will remember is, if you are constructing an asset, it is generally going to be assumed to be a qualifying asset, assuming it is taking a substantial period of time, because 12 months is not a necessary condition, at least for a numerical question. Second, if you are purchasing an asset, it is assumed to be ready for use and hence no capitalization unless otherwise given. This is one point that you need to know. Second, what happens is, when you look at the expenditure incurred behind the qualifying asset, the expenditure incurred will obviously include the cash payments or the assets purchased for constructing a qualifying asset, but it also includes the interest already capitalized. So, for example, in a multi-period problem, what happens is, let us say you are taking a 100 rupee loan and you have invested 100 rupees, you have paid the builder for the purpose of the house that he is constructing. Now, that 100 rupees is a part of the building under development account. At the end of the first year, you actually pay the entry, interest account debit to bank, and then asset account debit to interest, 10 rupees. So if someone asks you that at the end of the year or start of the next year, if someone asks you what is the expenditure incurred behind this asset, you will say 100 plus 10, that is equal to 110, and hence in the next year, if required, if someone says what is the expenditure incurred behind the qualifying asset, we will be taking 110. Accordingly, the solutions will proceed. Okay, so there are a few questions that we would want to address. There is a lot of questions in the LDR over here because the questions might be slightly different here or there. So let us review these questions and get a slightly better understanding. So let us go to question number 1. This is definitely a question that you will do for your LDR workings. X Limited began construction of a new building on 1st January 16. It obtained a 1 lakh special loan to finance the construction of the building on 1st January 16 on the very first day at an interest rate of 10%, which means on this 1 lakh loan, we will have 10,000 of interest on specific borrowings. The company's other outstanding loans are, you have non-specific. So these are general loans, are 5 lakhs into 11%, unless given otherwise, this will be outstanding for the entire year. 55,000 will be the interest. 9 lakhs into 13%. So this comes to, let's say, 1 lakh 17,000. So over here, if I total up 1 lakh 17 plus 55, this is 1 lakh 72. So this will be your total interest, 1,72,000 on the base of, I think, a 14 lakh borrowing. Again, this is outstanding for the entire year, and hence your weighted average borrowing rate will probably be 12.29% approximately per annum. Okay, now the expenditures that were made for the building were, so if I go to see all of these expenditures, this is 2 lakhs plus 250 plus 450 plus 120. So I have spent around 10 lakh 20. Out of which maybe 1 lakh would have gone from the specific borrowing, and hence the remaining 9 lakh 20 is probably coming from the general borrowing. And 9 lakh 20, well, your total borrowings are close to 14 lakhs, and hence you have adequate general borrowings to cover this expenditure. So if you sit to calculate the eligible borrowing cost, this is 2 lakhs. But the problem is, when is this money spent? Well, we have assumed that this money will be spent at the start of each month. One can always have 30 other assumptions depending on which date the money is spent, but institute over here generally assumes that if nothing is done, the money can be assumed to be spent at the start of the month, in which case 2 lakhs Acha, out of this 2 lakhs, is anything coming out of the specific borrowing? Yes, sir. 1 lakh. And hence the remaining 1 lakh will come out of the general borrowings at 12.29%. But for how many months? The building was completed by 31st December. Let us say we are solving for a calendar year. Following the principles of AS16, calculate the amount of interest to be capitalized and one journal entry for capitalizing. So we will say this will be for the 12 calendar months. So this will be 1 lakh. So this is 12,290. Then 2 lakh 50 into again 12.29%. Sometimes institute calculates something called as a average annual expenses. You can do that if you want to. I personally prefer doing it separately. So into 9 by 12, maybe this comes to 23,044. Then 4 lakh 50 again into 12.29% into, let us say, 6 by 12. 4 lakh 50 into 12.29% into 6 by 12 comes to around 27,653. And lastly, 1 lakh 20 into 12.29% into, let's say, 1 by 12. So this is 1 lakh 20 into 12.29% into 1 by 12 comes to around 1229. So these are all these numbers. If you sit and total up, this comes to around, I think, 51,925 approximately. So over here, just a second, I think I missed out something. I missed out 12,290 first wala. So 51,925 plus 12,290 comes to 64,215. Correct, 64,215. So if I go to say 64,215 is your borrowing cost eligible to be capitalized out of the total borrowing cost that you are paying of 1,72,000, and hence your borrowing cost to be capitalized is out of the specific borrowings around 10,000 and then 64,215, and hence the total is 74,215. The question says you pass an entry for capitalizing the borrowing cost as well as the total cost. So this is 10,20,000 that you are spending. So we'll say 10,20,000 building account debit. To institute usually says building WIP. You can always say to bank as well. Now the problem is this is 10,20,000. This is the total of all of these expenses. However, is my building expenditure only 10,20,000? No, 10,20,000 is directly spent for the building. Over and above that, around 74,215 is also going to be capitalized. So over here we will say, okay, building account debit to building WIP to, let us say, borrowing cost. This is 74,215 and hence 10,94,215. This will be the entry, as the question says. Pass one entry. Otherwise, we could have passed two separate entries for capitalizing the cost, that is total 10.2 lakhs that you are spending, and the borrowing cost, that is around 74,215 in respect of the building. Okay. So over here, this will come to your final answer. Okay, I will put this for my LDR workings. For sure, it's a good question. Then I go to question number 2. Now, on similar lines, you will have question number 2, 3, 7, 8 and even a couple of questions on the homework section on similar lines. So, we will review this question once. On 15th April 2019, RBM obtained a term loan of around 320 lakhs to be utilized as under. Construction of a factory is shared. You are constructing it. So, this can be taken as a qualifying asset. Purchase of machinery. Now, we are merely purchasing it. So, institute does not treat it as a qualifying asset. Not a qualifying asset. Working capital also not a qualifying asset. So, if I total each of these, this is 240 plus 30 plus 24. Acha, 294. There seems to be something else. On the next page, you are purchasing vehicles. Again, if you are purchasing, it is assumed to be in the ready to use condition, not a qualifying asset. Advance for tools and cranes. Again, this is just an advance given, not a qualifying asset. And purchase of technical know-how. If you were to develop a technical know-how which is taking a substantial period of time, it can be a qualifying. In line with institute solution, this is not a qualifying asset. So, if I take total plus 12 plus 8 plus 6, yes, this comes to around 320. So, my loan taken was 320, and sometimes we believe that the loan is taken for one purpose, but it is very much possible that the loan is taken for maybe 5 or 6 objectives, and these are the 5 or 6 objectives. Okay. In March 2020, the construction of the shed was complete and the machinery was installed, but you have merely purchased the machinery. Construction of shed took time. Total interest charged by the bank for the year ended 31st March 2020 was around 40 lakhs. In the context of AS16, show the treatment of interest and also explain the nature of the asset. So, we have explained whether they are qualifying or other than qualifying. So, if I want to find the treatment of interest, I will try to allocate the interest to each of this. So we will say that if my total interest is around 40 lakhs, what is a shed? We have assumed it is a qualifying asset. An argument may be made that this is from 15th April to around 31st March, and hence this is for 11.5 months, and hence maybe not a qualifying asset. But that is not what the institute looks at. It generally looks at these questions, and it generally says that, well, if nothing is given, this asset is assumed to be qualifying. Okay, so over here, institute has assumed to be qualifying. So out of the 40 total interest, which is for a 320 borrowing, out of 320, 240 I can say is attributable to shed, and hence I can do the working and say 30 rupees is attributable to shed. And what will I do with this? Sir, capitalize. Now for everything else I can sit and calculate if I want to. This is maybe 3.75, but this will be expense to P&L. Similarly 24 hai, so let's say this is maybe 3. What will happen? Well, expense to P&L. Basically everything else will be expense to the profit and loss account. So if I take out of the total 40, 30 as I can see will be capitalized, and the remaining interest of 10 will be taken to the P&L account. For an exam presentation, preferably explain that as per AS 16 what is a qualifying asset, what should be the treatment of borrowing cost for a qualifying asset, and what should be other than qualifying asset. Then say in the given case the treatment would be, so you will identify all of these items, next to that a qualifying asset, non-qualifying asset, allocate interest, and next to that write down. For 30 you can say capitalized, for 3.75 expense to P&L, 3 expense to P&L, and so on for all the other items as well. Okay, similar question is question 3. I would say this is similar to question 2. I will generally look at question 2, let's say for my LDR, and then another question, question number 8 for my LDR. These two should be sufficient. 3 will quickly review. Company took a term loan of 580 lakhs for modernization and renovation of its plant and machinery. So you are doing some work on your plant and machinery. Plant and machinery acquired under modernization and installation was completed by 31st March 17. That amounted to 406. 58 lakhs has been advanced to supplier for additional assets, and balance of 116 has been used for working capital purposes. So if I look at this, there is 406 for modernization of plant and machinery. There is 58 which is for advance given to suppliers, and there is 116 for the working capital. So if I total this, I will possibly get 580, and this shows me the utilization of 580. The accountant is in a dilemma on how to account for the total interest of 52.2 incurred during 16-17 on the entire institutional term loan of 580 lakhs. So out of 580 we are saying if 52.2 is the interest which is for total into 406 upon 580, 52.2, so this is, let us say, I think 36.54. Now what will I do with this 36.54? This is attributable to modernization and renovation of the plant and machinery, which is assuming to be taking a substantial period of time, and hence this is towards a qualifying asset. So what will you do? Sir, capitalize. For the other items, let's say 52.2 into 58 upon 580, that comes to around 5.22. Well, this is for an advance for additional assets. Institute does not assume these advances or purchase of assets to be qualifying, and hence it will go to the P&L account. And similarly 52.2 into 116 upon 580 will come to probably 10.44, which will also be expense to the profit and loss account. So over here this will be your breakup of the entire. So this is 36.54 capitalized, 5.22 expense to the P&L, and even 10.44 expense to the P&L. This is question number 3. Now question number 4 is an interesting, it is a case based question. I will put this for an LDR. It is a case based question where there are certain facts given from which we have to figure out whether the asset is a qualifying asset or not. So Take Limited has borrowed 30 lakhs from SBI. So there is SBI which has given a 30 lakh loan to Take Limited. During the year 16-17, the borrowings are used to invest in shares of Give Limited. So what has Take Limited purchased? Equity shares of Give Limited. Okay. Can shares be qualifying asset? Answer is no. Which is a subsidiary company of Take Limited and which is implementing a new project estimated to cost 50 lakhs. So basically this is a subsidiary. We are saying that even if it is a subsidiary, it does not really matter. In the books of Take, there is just investment in shares. By the way, this is using the money for the qualifying asset. Does not matter. Take is using the money to invest in equity shares. As on 31st March 17, since the project was not complete, the directors of TEC resolved to capitalize the interest accruing on the borrowings of 4 lakhs and add it to the cost of investment. That is not correct. Why? Because this is the money spent for the purpose of acquiring investment in shares, and investment in shares are not a qualifying asset, and hence irrespective of what Give Limited does with the money in the books of TEC, the assets are investment in Give Limited, which is not a qualifying asset, and hence the treatment suggested is not correct. This is question number 4. Next, you go to question number 5. Now, in May 16, Capacity took a bank loan to be specifically used for the purpose of construction of a specific new factory. So, this is a specific borrowing. The construction was completed in January 17. So, maybe this takes what? Close to maybe 7 or 8 months. And the building was put to use immediately thereafter. Now, interest on the actual amount used for construction of the building, interest on the actual amount used for the construction of the building till its completion was 18 lakhs, whereas the total interest payable to the bank on the loan till 31st March 17 amounted to 25 lakhs. Now, the thing is, after the building is ready for use, still there might be certain interest, but you will only capitalize till the time the building is ready for use, not beyond that. Can 25 lakhs be treated as a part of the cost of the factory building and thus be capitalized on the plea that the loan was specifically taken for the construction of the factory building? The answer is no. Explain the treatment in line with the provisions of AS 16. Again, the problem over here is the asset is barely taking around 8 months. So, ideally one can always argue that this is not a qualifying asset. However, the institute does not look at it that way. I don't know why. But nevertheless, it says that if the question is asking you a specific thing, we will give a conditional answer. Institute does not do that. But let us say if you assume the asset to be a qualifying asset, then what will we say? We will say that if the asset is assumed to be a qualifying asset, then 25 may say only 18 can be capitalized, and 7, which is 25 minus 18, will be expense to P&L. However, if you assume not a qualifying asset, then the entire 25 will be expense to the P&L. So, the contention of the company to capitalize 25 is out of question. So, depending on whether it is a qualifying asset or not, these are the two treatments possible. But capitalizing the entire 25, no, that's definitely wrong. That is out of the question. Okay, then you have question number 6. A company is incorporated in June 17, has set up a factory within a period of 8 months with borrowed funds. Okay, the construction period has reduced drastically due to usage of technical innovations by the company. So, you have specifically told by 8 months mein hua. However, that is due to technical innovations or double shifts used by the company. Whether interest on the borrowings for period prior to the setting up of factory should be capitalized. So, during that construction period, should it be capitalized? Although it has taken less than 12 months for the asset to get ready for use, you are required to comment on the necessary treatment with reference to AS 16. Well, if your asset ordinarily takes a substantial period, that is greater than 12 months, then it is a qualifying asset, in which case interest will be capitalized. Sir, but it is only taking 8 months. Maybe that is due to technical innovation, and hence we are not going to say that the asset is not a qualifying asset. Maybe due to emergencies you had to construct it really fast. However, ordinarily it would have taken a substantial period of time. Then it is a qualifying asset, and interest during those 8 months should be capitalized. So, over here if you say hence the borrowing cost for 8 months should ideally be capitalized. Now, question number 7. I think 7 या फिर उसके बदले 8 is a better question for LDR, I would say. Have I written? Yes, okay. 8 is a slightly better question for LDR. I have marked 2 earlier. 2 and 7 are by and large the same. Zen Construction obtained a loan of 64 crores to be utilized as under construction of a hill link road in Kedarnath. You are constructing a road, unless given otherwise it is a qualifying asset. Purchase of equipment and machineries, you are purchasing something, so this is not a qualifying asset. Working capital is not a qualifying asset. Purchasing, again, vehicles not treated as a qualifying asset. Advance, not a qualifying asset, and purchase of technical know-how, not a qualifying asset. You can keep question number 7 also for LDR, that is fine. 7 and 2 are by and large the same. Total interest charged by the bank for the year ended 31st March 18 is 1.6 crores. Show the treatment of interest as per AS for Zen. So, we will say that if I total all of this 50 and 6, 56 and 4, 60, 60, so this is 64 ka breakup. So I will say out of 64 जिसके लिए 1.6 का इंटरेस्ट लग रहा है, 50 is for construction of a road which is a qualifying asset, and hence 1.6 into 50 divided by 64 comes to around 1.25. This will be capitalized. Now if everything else is not a qualifying asset, for simplicity we can say that the remaining जो अपन calculate करेंगे, remaining comes to let's say 0.35, and where will this 0.35 go? Sir, it will be expense to the profit and loss account. So over here this will be 1.6 crores, this will be for a qualifying asset, everything else you can break up, and 1.25 crores and 1.6 crores, 0.35 crores will be expense to the profit and loss. Okay, question number 8 has one interesting adjustment similar to question 2, 3, 7 and 8. Govind issues 12% secured debentures of 100 lakhs on 1st April 18 to be utilized as under. So for construction of factory building, you will assume this is a qualifying asset. Purchase of machinery, you will assume it is not. And working capital also you will assume it is not. One can always argue that I can purchase a machinery and it can take a substantial period of time to install it. In which case it may be a qualifying asset, maybe. However, institute never takes that, so we will always assume that these assets which are merely purchased are not qualifying assets, but assets which are constructed are usually qualifying assets. In March 19, the construction of the factory building was completed and machinery was installed and is ready for intended use. Now the total interest on the debentures for the financial year 31st March 19 was 12 lakhs. Achha, even if it was not given, 12% of 100 lakhs comes to 12 lakhs. During the year 18-19, the company had invested idle funds out of the money raised from the debentures in bank deposits and earned an interest of 3 lakhs. This was not there in the earlier problems. So over here you can probably highlight this. We had invested surplus funds and earned an income of 3 lakhs. So वैसे you have paid 12. However, income on temporary investment is 3 and hence the net borrowing cost to be capitalized will be, for example, 9. You are required to show the treatment as per AS 19. So we will say 12 minus 3, that is equal to 9, and hence allocation, if any, will be based on 9. 9 into, if I total up all of this is 100, 9 into 40 by 100, which will come to maybe 3.6. This will be capitalized because it is for a qualifying asset. 9 into 35 by 100. So this is 9 into, for example, this is 3.15. This will be expense to P&L, and 9 into 25 by 100, maybe 2.25, again will be expense to the profit and loss account. So over here 3.6 capitalized, 3.15 expense, 2.25 expense to P&L. The important thing over here is this working, that you take 12 minus 3, that is equal to 9 lakhs for your calculation. So this is question number 8. Next you go to question number 9. Now Vital Limited borrowed an amount of 150 crores on 1st April 19 for construction of a boiler plant. This is to construct something at 10% per annum. The plant is expected to be completed in 4 years. So definitely this is a qualifying asset, takes 4 years. Since the WACC, weighted average cost of capital, is 13%, accountant of Vital capitalized 19.5. Now, how did they calculate 19.5? They must have taken 150 into the WACC of 13%. That comes to 19.5. But this is clearly wrong. Why? Because capitalization does not happen based on WACC. It actually happens based on your borrowing rate, which I think over here is 10%. For the accounting period ended 31st, so Vital capitalized 19.5 crores for the accounting period ended 31st March 2020. Due to surplus funds out of 150 crores, an income on 1.5 crores was earned and credited to the profit and loss. Wapas galti. So this income on temporary investment cannot be credited to the profit and loss account. In fact, it will be reduced. Comment on the treatment done by the accountant with reference to AS 16. We will say ideally the correct should be 150 into 10%. This is the borrowing rate, that is 15 minus income on temporary investment of 1.5, and hence the net 13.5 should be capitalized because it is for a qualifying asset which is taking 4 years. So net 13.5 should be capitalized. Okay, next you go to question number 10. Now this is regarding that forex adjustment which we have not studied, and we will do this probably at the end. So let us keep that aside. Go to question number 11. An enterprise has constructed a complex piece of equipment which is a qualifying asset that is installed on the production line of a manufacturing plant. Okay, again we have made a complex piece of equipment. Let us say a missile. You made a missile that is installed on a production line of a manufacturing plant. Let us say that is to be installed in an aircraft. The equipment has been constructed over a period of 15 months. It took 15 months to make the missile, so it is a qualifying asset. However, on installation, certain calibrations, means adjustments, are required to achieve the desired level of production before it is finally commissioned. So maybe before we can say missile is ready for use, it may take 15 months for the missile. to be made, but then that missile has to be properly fit into the aircraft. This process is expected to take another 2 months, during which test runs will be made. Should the borrowing cost attributable to borrowing pertaining to those 2 months be capitalized? The answer is yes. Remember, you capitalize till the time the missile is ready for use, and for it to be ready for use, yes, it takes 15 months to make the missile, but another 2 months before it can be said to be ready for use, and hence the borrowing cost for the entire 17 months, that is including the 2 months over here, should be capitalized. So this takes care of question number 11. Next we have question number 12. Should capitalization of borrowing costs be continued when the qualifying asset has been constructed? So it is done, but marketing activities to sell the asset are in progress. The answer is a clear no. The asset is ready for use. It is like saying that you are a builder, you constructed the flats, it took you 3 years to construct the flat. Now the flats have been constructed, but now you are marketing to sell those flats. Well, the flats are ready for use and or ready for sale, as the case may be, and hence capitalization has to stop at this point. Okay, so your answer is no. Then you go to question number 13. Now 13 is a little interesting question. This is similar to question number 2, 3, 8 and 10. 7 and 8. But in almost all of these questions, if your loan was, let's say, 580, your expenditure was also 580. But is it possible that your loan, for example, is 580, but you end up making an expenditure of more than that? In which case, how much will you capitalize? Well, whatever be your expenditure, your capitalization will be based on how much interest you are actually paying. You might make an expenditure of, for example, 250, but the borrowing is only 200, then your actual interest will be on 200, and whatever is the actual interest, you will allocate in the ratio of the expenses incurred and then find. So for example, over here, let us say, just thinking aloud, in question number 2, you had a lot of these things, and ultimately a total aapko kitna aa raha tha? Borrowing was 320 lakhs. My point is, what if the borrowing was not 320 lakhs? If I total up, this expenditure is 320 lakhs, borrowing is also 320 lakhs, but what if your borrowing was, for example, 300 lakhs? And on that, maybe you calculate some rate of interest. I don't know what the rate of interest is, but let us say kuch to apne calculate kiya, and pro rata your interest, for example, comes to 35 rupees, not 40 rupees. In which case, what will you do? You will allocate this 35. You will allocate 35 rupees, that is your actual borrowing cost, in the ratio of the expenses which have been incurred, pro rata. So you will apply this in 2 of the questions which are interesting, question 13 as well as question 15 on similar lines. So there are some corrections over here. You can see that on your screen. Harish Construction Company is constructing a huge building project consisting of 4 phases. It is expected that the full building will be constructed over several years. So it is a qualifying asset. But phase 1 and 2 of the building will be started as soon as they are completed. So here it is possible that your asset gets ready to use phase wise, in which case capitalization will cease proportionately. Following is the detail of the work done on the different phases of the building during the current year. So maybe some on phase 1, cash expenditure as well as building purchase, sir, total is 34. Phase 2, cash expenditure and building purchase 64. Phase 3, maybe 55. Phase 4, total 68 during the current year. Now what is this building purchase? Let us say you were buying an old building, paying 24 rupees and then making changes as you want of 10 rupees to get the phase in the ready to use condition. So something like that, maybe. So this is your total expenditure. If you calculate total expenditure on all the phases is 221. 221 is nothing but the total of all of these. But the loan taken at the rate of 15% at the beginning of the year is only 200. So here your expenditure increase is 221 and the loan taken is only 200. Now people say, how is that possible? How can you have expenditure more? Paisa kahan se aaya? Well, you might have your own money of 21 rupees on which there is no borrowing cost, which is probably used. However, the borrowing cost is only on 200. So basically, if you sit to calculate the borrowing cost, this is 200 into 15%, let us say into 12 by 12. So your total borrowing cost is rupees 30. Now this 30 is attributable to phase 1, 2, 3 and 4. All of these. In what ratio? In the ratio of these expenses. So this is easy. During the middle of the current year, phase 1 and 2 have become operational. So they become ready for use, and hence capitalization, if any, for phase 1 and 2 can only be done for these 6 months. 3 and 4 capitalization for the entire 12 months. Find out the total amount to be capitalized and the amount to be expensed during the year. So if I were to go on this, I would say, now institute has done it in a particular way, but I would say that, let's say if I look at phase 1, phase 2, phase 3 and phase 4. So I would say out of the total 30, into 34 divided by 221. 30 into, let us say, I think second phase में कितना जा रहा है 64 out of the 221. 30 of total interest into third phase and fourth phase. 30 into, I think fourth phase is 68 upon 221 and this is 55 upon 221. So if I sit and calculate for each of this comes to what? 30 by 221 into 34 comes to, I think, 4.62 approximately allocation. 30 into 64 divided by 221, maybe 8.68 approximately 69 but let's say for simplicity 68. 55, sorry, 30 into 55 by 221 comes to 7.47 and 30 into 68 divided by 221 comes to 9.23. So this is your allocation. Now the question asks you how much should be capitalized. Well, the thing is, the capitalization and expensing to P&L for the first project for 6 months, that is 2.31 will be capitalized and 2.31 will be expensed. For the second phase, 4.34 will be capitalized, 4.34 will also be expensed, but for the third and the fourth phase, nothing will be expensed. The entire 7.47 will be capitalized, 9.23 will be capitalized. So over here, if you sit 2.31 plus 4.34, this is around 6.65 which you will expense, plus 7.47 plus 9.23, 23.35 you will capitalize. So this is your total 30. Out of 30 we are saying approximately 6.65, as you can see, should be expensed. Okay, and over here the total of these two will be around 16.69 will be capitalized. Okay, so there was a wrong solution printed for some other concept over here, so we have just removed that. Now question number 15 is on the calculation of capitalization. Question number 15 is a recent May 23 exam question, which is an important one, but before that, question number 14 is on capitalization rate. So what I'll do is I'll first discuss 15 because 13 के साथ वो extension में आता है, so we'll just finish off 15 which is from the May 23 exams first. On 1st April 2022, Workhouse took a loan from a financial institution for 25 lakhs for construction of building. So this is at 12%. This is specific borrowing, which is taken specifically for the purpose of acquisition of a building. In addition to the above loan, the company has taken multiple borrowings as follows. So this is total, if I go to see, 45 and maybe 63 lakhs worth of borrowings. This is in addition to the loan. So this must be general borrowings. The company has utilized the above funds in construction or purchase of the following asset. Building 70. Achha, 70 mein se one needs to remember that 25 lakhs will be out of specific borrowings and hence the remaining, I think 45 lakhs will come out of the general borrowings. Furniture, maybe entirely, plant and factory shed entirely. The construction of the building, plant and factory shed was completed on 31st March 23, but ready-made furniture was purchased directly from the market. So basically building can be qualifying, furniture is non-qualifying, plant and machinery can be qualifying, factory shed is also a qualifying because it is taking a substantial period. Now if I total up all of these, 45 lakhs out of general borrowings can be used for building, 22 lakhs of furniture, 90 lakhs of plant and 43 lakhs of the factory shed. So if I total up all of this, 45, 22, 90 and 43 comes to around 200 lakhs. So we are saying this is out of general borrowings, 200 lakhs ka kharcha karna hai, but your borrowings are only 63 lakhs, which means your actual interest, whatever that is the only amount that will be capitalized. So over here, 15 lakhs into 8% comes to, I think, 1 lakh 20. 30 lakhs into 15% comes to, I think, 4 lakh 50. And 10% comes to 1 lakh 80. So if I total all of this, my actual interest comes to 7 lakh 50. Now technically this 7 lakh 50 should be allocated to all of these items in the ratio of their expenditures, because usse zyada tum capitalize kar hi nahi payege. You can sit and calculate the WBR if you want to and you find the eligible borrowing cost to be capitalized, but your actual borrowing cost is not going to be more than 7 lakh 50, and hence your maximum capitalization will be restricted to 7 lakh 50, and that 7 lakh 50 will be spread between these items in the ratio of their expenses. Factory was ready from 1st April 23. You are required to calculate the borrowing cost for both qualifying and non-qualifying assets. So this is for both qualifying as well as non-qualifying. So how will I do that? Well, if I have space over here, multiple ways in which this can happen. So when I look at, let us say, building, for building there is a specific borrowing on 25 lakhs, there is a specific borrowing at the rate of 12% into 12 by 12. तो यहाँ पे तो कोई ambiguity है ही नहीं. On this 25 lakhs into 12%, I think 3 lakhs. This will be capitalized along with the building. Now, building out of the general borrowings, वैसे तो 45 है, but 45 out of 200. अच्छा, now the total borrowing cost attributable actual on general borrowings is 7.5. So like you were doing in earlier problems, I'll say there are multiple ways possible. This is one of the easier and consistent way. I would say 7.5 ka interest. A part of it is going to the building. So 7.5 into 45 out of general borrowings comes from the building. 45 वैसे तो 70 but 25 is taken out of specific borrowings into 200 comes to what? 1.6875. What do I do? Sir, capitalize. Achha, then comes furniture. Now furniture is not a qualifying asset. So I will say whatever expenses of 20 which was made for the furniture, this will, okay, there will be some interest attributable to that like you were doing in earlier problems. However, that will be expense to P&L. So over here, this will be, let us say, the capitalization section. This will be the expensing to P&L section, and hence I think 0.825 or 82,500 will be expense to the P&L. Then you look at other items like plant and machinery, and you look at factory shed. Over here, when you look at plant and machinery as well as factory shed, these are both qualifying assets, and hence whatever is the money spent, let's say 90 by 200 into 7.5. So this is, let us say, coming to 3.375, this will be capitalized. And lastly, for factory shed, if I go to see, this is probably spending 43 lakhs. So this is 43 out of 200 into 7.5. So this is 7.5 on the base of 200 into 43 comes to around 1.6125. This will again be capitalized. So if I look at the total amount to be capitalized, अरे यार ये क्या था 0.0375 into 7.5 3.375. So this is 1.6125 and 3.375 and 1.6875 and 3 comes to around 9.675 to be capitalized and 0.825 to be expense to the P&L account. So if I go to see over here, okay, this is 6.675. They have kept specific separately. I think if I remove this, तो वो 6.675 हो जाएगा. And then they have separately added 3.0. So this is 6.675 and 82,500. And यहाँ पे आप देखो, they have taken 3 lakhs for specific 67,500, and this is the amount to be capitalized for furniture 82,500 to be expense to P&L account. So this is regarding question number 15. Next you go to question number 14. Now this is on calculation of capitalization rate, also called as weighted average borrowing rate. Remember, when you look at the borrowings, like you have a concept of qualifying asset, you don't have a concept of qualifying borrowings, which means that even if there's a short-term borrowing like a bank overdraft, that can also be a part of the general borrowing pool. So you will not just look at long-term borrowings, even short-term borrowings can be taken. So over here, ABC Limited has started construction of an asset on 1st December 21, which continues till 31st March 2022. So this continues for 4 months and is expected to go beyond a year. So this is probably a qualifying asset. The entity has not taken any specific borrowings to finance the construction of the asset, but has incurred finance cost on its general borrowings during the construction period. Okay. The directly attributable expenditure at the beginning of the month on the asset is 10 lakhs in December, 4 lakhs in each of the month of January to March. So in case you are asked to calculate the amount to be capitalized, this is the expenditure incurred. At the beginning of the year, the entity had taken an intercorporate deposit of 20 lakhs at the rate of 9% rate of interest. So this is also a borrowing. Maybe it's an intercorporate deposit, you have to pay interest. So this is also borrowing, general, and an overdraft of 4 lakhs, which increased to 8 lakhs on 1st March 22. So your overdraft is changing. And interest was paid on the overdraft at 10%. until 1st January 22, and then the rate has increased to 12%. So this is a little complicated, this part. You are required to calculate the annual very clearly given capitalization rate for computing borrowing cost in accordance with AS 16. So if you want to find the annual borrowing cost, in the numerator you will have to take the annual interest, as well as in the denominator the borrowings throughout the year. So if I look at actual interest in my numerator, I would say that over here I will say the problem is for my bank overdraft. From the very first day, that is 1st April, all the way till 1st January, the overdraft was 4 lakhs and the rate I think was, how much was it? 10%. Then I think the rate increased till 1st March to 12%, but the overdraft is still 4 lakhs. And then for the last 1 month till 31st March, this became 8 lakhs and the rate became 12% still. So over here, if you were to calculate the weighted average borrowing rate, in the numerator you will take the actual interest, which is 20 lakhs on the intercorporate deposit into whatever is the rate of 9% into 12 by 12. This is outstanding for the entire 12 months. And hence, against that, in the denominator, you will have the borrowings for the entire 12 months plus 4 lakhs, which is there at the rate of 10% for a period of 9 months, plus again 4 lakhs, which is there in overdraft at the rate of 12% for a period of 2 months, that is January and February, plus 8 lakhs, which is there at the rate of 12% but for a period of 1 month. So you'll do this math. In the denominator, even your borrowings will be time value adjusted. So this is 20 lakhs, which is there with you for a entire 12 months. 4 lakhs bolne ke liye is there with you for 9 months at the rate of 10%, another 2 months at the rate of 12%, but it's basically 4 lakhs is there with you at 9 plus 2, that is 11 out of 12 months, and then 8 lakhs is there with you for the last 1 month. And hence you will try to find the number in the numerator. If you sit and calculate this, the number in the numerator probably will come to 2,26,000 shayad se, and in the denominator 24,33,334. So it will be 2,26,000 divided by 24, 33,333. And if you calculate, this is around 9.29% per annum. This is annual rate. Sir, question has told me to find the annual rate because most of the times what companies will have is someone like a Reliance Jio will have hundreds and thousands of projects. So we will not sit and calculate the WABR separately for each project. Some might start in December, end in March, some might start in July, end in somewhere else. So you will try to calculate WABR for the entire company, like you have a WACC for the entire company and then you apply it for project evaluation. Similar to that is a slightly more feasible approach. So institute has asked you to find the annual capitalization rate, and hence we have. So काफी बच्चे बोलते sir, but the project is started on 1st December. हाँ, so if the question had asked you to calculate eligible borrowing cost, then I will start at 10 lakhs, which is incurred on 1st December for a period of 4 months only, at the rate of 9.29% per annum. Then for every month, I will have, I think 4 lakhs, या फिर जो भी 4 lakhs, and that will be at the rate of 9.29% into 3 by 12, 2 by 12, 1 by 12 as the case may be. However, the rate is a percentage per annum rate. Question is asking you to find the annual capitalization rate. Okay, so this takes care of question number 14. 15 is done, and then in a very recent RTP of September 24, this is a fairly complicated question. This is question number 16. Over here, a few points that you have to remember, and if it comes, you will solve it in a similar way. You will not have a variation on this question, so just keep that in mind, and we will do question number 16. So over here, what did we say? Expenditure incurred on a qualifying asset. Remember, expenditure incurred on a qualifying asset includes the cash payments plus also interest capitalized. Usually for a single year question, interest is paid at the end of the year and we don't have data for the next year, but sometimes interest may be paid at the end of a month. So your entry will be interest account debit to bank for each month. Your entry will be interest account debit, let us say, to bank for each month, but then that interest has to be transferred somewhere. So if you are passing the entry for each month, because you are paying interest on each month, then the second entry, if it is a qualifying asset, then qualifying asset or asset account debit to interest. Capitalization will happen each month. Okay. Secondly, remember, when you incur expenditure, it is not just looked at it in isolation. It is looked at on a till date basis. Like for example, if you were to buy a building in a flat in an under construction property, in the first year you have paid 4 lakh rupees. Second year you pay another 2 lakh rupees. So when you see how much interest you have to pay, you will say in the second year you have to definitely pay interest on the 2 lakhs, but even the 4 lakhs that you have drawn out in the first year and the asset is still being constructed, so effectively you have to pay on 6 lakhs, 4 and 2. Further, if someone asks you how much is the money that you spent behind the qualifying asset, you will say 4 lakhs spent in the first year, paid to the builder, plus maybe 40,000 on that 4 lakhs paid to the banker, so 4 lakh 40. Plus another 2 lakhs which is paid, let us say, in the second year. So this is 6 lakh 40, which must be the balance in your building under development account, on which interest may be levied, let us say, for the second year. We will apply this over here. Also, you might be given planned expenditure, actual expenditure. Remember, capitalization is based on actual spending and actual expenditure is relevant. Sometimes your work may be interrupted, so there will be suspension if no active development is happening. But even if physical work is not happening, if some other work like technical planning, site evaluation, substantial other administrative work is happening, your capitalization will still continue. Also, while doing capitalization for each month or each year, you have to ensure that you compare the expenditure incurred with the amount of borrowings. You cannot capitalize beyond the actual interest. If there are no borrowings, well, no matter how much expenditure you have incurred, there's no borrowing cost, what will you capitalize? Or if the borrowings are, let's say, 10 rupees and you have spent 15 rupees, then your capitalization will be based on 10 rupees only. Okay, keeping all of these points into consideration, we will try question number 16. It's a fairly complicated question, I would say. Let us review this. Loyal Limited has undertaken a project for expansion of capacity as per the following details. So you have the following details. From October to 23 to March 24, you have the planned expenditure and actual expenditure. Planned expenditure is not relevant. Your capitalization will be based on actual expenditure only. The company pays to its bank interest at the rate of 15% per annum, which is debited on a monthly basis. This is a problem. Debited on a monthly basis, which means the entry for interest will be passed on a monthly basis, and hence capitalization, if any, will also happen on a monthly basis, which was not there in the earlier problems. We are passing entry at the end of the year. During the half year, company had a 20 lakh overdraft up to 31st December. Surplus cash, another problem. In January, and again overdraft of 14 lakhs from February and 30 lakhs from March. So this is basically your borrowing amounts. The company had a strike during December and hence could not continue work during the said period. However, substantial administrative work relating to the project was still continued, which means even if there was a labor strike, other work on the project was happening, there will be no suspension. If this sentence was not given, that substantial other work was continuing, then we would have suspended capitalization for the month of December. On-site work was again commenced on 1st January and all works were completed by 31st March. Now, technically, if you are starting the work in October and ending in March, it is just a 6-month period, but as we have discussed earlier, Institute believes that these would be qualifying assets. Assume that the expenditure was incurred on the first day of each month. Calculate interest to be capitalized, giving reason where necessary. Assume overdraft will be less if there is no capital expenditure. So if there was no capital expenditure, there will be lesser overdraft. So what we will do is we will try to prepare a particular format and solve based on that. If a question comes on these lines, you can go on by this format. So if I look at this on a month, let's say the first month is October. We will first figure out how many borrowings are there outstanding during this month. Then if there is any opening expenditure, so there is any opening balance or opening expenditure till date which is there in your building under construction, and then you will have expenditure during this month, which will give you the adjusted opening. Okay, once you do that, then you can find the interest or eligible interest to be capitalized, if any. Eligible interest to be capitalized, if any. So over here, let's say this is column 1, this is column 2, column 3, column 4, column 5. Achha, column 5 will equal to the column of column 3 plus column 4, opening plus expenditure incurred at the start of each month. Eligible interest, this will be calculated as the lower of column 2, that is borrowings, or expenditure incurred, that is column 5, into the interest rate into the time period, let's say 15% into 1 by 12. We will do this, so you will get clarity, and then you will find the closing, the last column. Let's say this is column 7. Column 7 will be equal to the adjusted opening, that is 5, plus column 6 on eligible interest to be capitalized if any. Okay, so if you understand this question, well and good, but otherwise just as long as you are clear with the other parts of the standard, I think this should be workable. So if you look at October over here, what is the borrowings? Well, October meant there was a 20 lakh borrowing, there was no opening balance, and during October you spent, I believe, 4 lakh rupees, which means if there was no opening balance, your closing your adjusted opening will be 4 lakhs. Now your interest will be, you will compare 4 or 20, whichever is lower. So you will say, ठीक है यार, out of the 20 lakhs of borrowing, 4 lakhs is for the qualifying asset into 15% into 1 by 12. This is to be debited each month. So this is 4 lakhs into 12% divided by 12 comes to what? Again 4 lakhs into 12% divided by 12 comes to, I think, 4,000. And hence at the end you will have 4 lakh 4,000 into your 4 lakh 5. Acha, 15% and not 12%, sorry. 4 lakhs into 15% divided by 12 comes to 5,000. So this is 4 lakh 5,000. Sir, how? Well, expenditure incurred includes interest capitalized. So at the end of the month, you will pass the entry interest account debit to bank 5,000. So interest has to be transferred somewhere, asset account debit to interest. Now, if you go to the month of November, your borrowings are still 20 lakhs. If someone asks you that what is the expenditure incurred behind the qualifying asset till date, you are an accountant. For an accountant, you will open your ledger, and in your ledger, your opening balance is 4 lakh 5,000. So you will say that till this date, 4 lakh 5,000 has been spent. Okay. Now at the start of November, you are going to spend another. Acha sir, kitna? You are going to spend another 7 lakh 95,000. So this is 7 lakh 95,000. So if I total 795 and 405, I come to, I think, 12 lakhs. If I want to calculate interest, I will say 12 lakhs or 20 lakhs. Acha, out of 20 lakhs, 12 lakhs is used for a qualifying asset into 15% into 1 by 12. So this is, for example, 12 lakhs into 15% divided by 12 comes to around 15,000. And interest account debit to bank and asset account debit to interest. So your total will be 12 lakh 15,000. Now comes the month of December. Now December mein actually your borrowings is still 20 lakhs. Opening balance was 12 lakh 15,000. No expenditure is incurred as given in the question, and hence your adjusted opening is also 12 lakh 15,000. Now I would say that I still have to pay interest on 12 lakh on 20 lakhs, out of which 12 lakh 15,000 is attributable to a qualifying asset, and hence I would say that over here into 15% divided by 12 will possibly come to 15,188. 15,188, and hence your closing comes to 12 lakh 30,188. So when I go to the month of January, my borrowing becomes nil. But in my ledger, I have 12 lakh 30,188, and in fact, work is commencing. I spend more money, another 50,000. So this becomes 12 lakh, I think, 80,188. But interest aayega hi nahi, because if there is no borrowing, there is no borrowing cost. How can there be an interest? And hence this closing continues to be 12 lakh 80,188. Now when you come to February, borrowing comes up to 14 lakhs. Remember, one can always say that this is new borrowing. Well, you don't have to match the money. If a particular month there is expenditure incurred on the qualifying asset, there is borrowing, you will allocate the borrowing cost to the qualifying asset. So this is 12 lakh 80,188 plus another 2 lakhs being incurred, and hence your total expenditure comes to around 14 lakh 80,188, on which we will say 14 lakh 80,188 into 15% into 1 by 12. But sir, उतना तो मेरे पास borrowing है ही नहीं, and hence I will select lower of the two, and hence between 14 lakh 80 and 14 lakhs, we will say my actual borrowing is only 14 lakhs, so nothing beyond that is going to be as a part of my interest. Divided by 12, this comes to 17,500. So I will capitalize 17,500 on my ledger balance of 1480. 188. I might have 1480, 188. However, my borrowing is not as much. So this is 1497, 688. And in the last month, in the month of March, you have a good 30 lakhs worth of borrowing on 14 lakh 97, 688. I believe you spent another 12 lakhs in the last year, and hence this is 26 lakhs 97,000, 688 into 15% divided by 12, because it is less than 30, and comes to 33,721, and you will get the answer. The question asks you how much is the interest to be capitalized. You will take the total of all of these numbers, and you will possibly get around 86,409. So just in case this question lands up, this is going to be on similar format. I've made slightly different columns as compared to what is there so that I can even compare the borrowing, and this is how you will solve. There can be debatable assumptions over here, but Institute has done this multiple times over a lot of years, including the recent RTB of September 24 as well. So in case it comes, you will kind of go on similar lines. Now, over here, in your homework problems, you can practice the problems. Question 1 is from the exam questions. It is similar to question 1 of the classwork. In question 2, also it is similar to question 2 of the classwork, just that there is a line over here which mentions that construction of ceiling across 2 cities and work was held up for a month due to high water levels. Now, Institute has either assumed that this is what ICA has done. I am not saying that this is right or wrong. ICA has either assumed that these high water levels are normal and hence no suspension is done, or ICA is either assumed over here that these high water levels for 1 month is not an extended period and hence they've ignored this sentence and done the working in the usual manner. जैसे अपना जो total 32 crores का borrowing है, on which you will have an interest which is 80 lakhs, you have directly allocated 80 lakhs in the ratio of expenses, 80 lakhs into 25 by 32. नहीं, but if 1 month का suspension करने का रहेगा, then out of this 62 lakh 50, 11 months of interest will be capitalized, 1 month will go to the PL. Institute has not done that. That is one thing. Then question 3 starts over here. There's nothing new per se over here. Question 4 is on that foreign exchange. Question number 5 is similar. I mean, it's similar to question number 8 rather of your classwork problems, where you have a 12% debenture of 100 lakhs. Money is raised from debentures to be used for all of these purposes. Interest on debentures was paid by the company. But the only challenge over here is this money was raised on 1st June. So ideally your total will be 100 lakhs into 12% into 10 by 12. And hence this will come to possibly, I think, 10 lakhs. And then if you keep on reading further, you have been told that the company invested surplus funds to earn 50,000 and hence your total will be 10 minus 0.5, that equals to 9.5. अगर आप चाहिए तो आप ये देख सकते हो. I'm saying that there's nothing new over here, but even if it is a homework question, I want to kind of quickly discuss this so that you have clarity. So in case that borrowing is happening on 1st of June, obviously your interest will be based, as you can see over here, as 10 lakhs into 12% into 10 by 12 minus 50,000 and hence 9 lakh 50. Abhi ek baar 9 lakh 50 aa gaya, that 9 lakh 50 is allocated to all of these items in the ratio of 40 is to whatever is the total, 30 is to whatever is the total, and so on. So this kind of takes care of all the concepts except for this last item, exchange differences, to the extent they are treated as adjustment to borrowing cost. We will discuss this, let us say, keeping some principles of AS 11 into consideration. So this entire section of this chapter you will ideally do if you have a slightly basic understanding at least of AS 11, monetary items, non-monetary items, closing rate, historic rate. That really helps to cover this part of this AS 16. So if you have not done that, you can kind of come back to this section later. However, otherwise we can kind of quickly discuss this and get done with this last concept of AS 16. Here what happens over here is we have, let us say, a loan that you have taken in the foreign currency. Now loans as per AS 11 are monetary items, and monetary items have to be shown at the closing rate at each balance sheet date, and whatever is a gain or loss is typically taken in the profit and loss account, because foreign exchange gain or loss on monetary items will go to the profit and loss account. Now what happens generally is, for example, when I look at let us say a case, we'll probably take an example over here from the homework section as a base, and we can use that as an example. So usually when you take a loan in the US or in, let us say, Japan, etc., the loans are available at a slightly cheaper rate, and hence if I were to take a loan in the US, it may cost me 4%. So I will say that, well, if the loan cost, the interest is 4%, and if this loan is taken for a qualifying asset, then whatever is the loan amount into 4%, that will come in dollars, into whatever is the appropriate rate will give me the borrowing cost. However, if a similar loan is taken in India, it may cost me around 10, 11, 15%. So apparently you are saving borrowing cost if I were to borrow in the US, and hence if it is a qualifying asset, only that borrowing cost which you are actually paying, and rightly so, should be capitalized. You are paying less, well, lesser borrowing cost should be capitalized. However, internationally accepted exchange rate theories will tell you that there is a very strong relationship between interest rate and exchange rate. So generally economies which have a lower interest rate like the US We'll have usually a stronger currency, and thereby you will see that over the years, India, which has usually a higher interest rate because of the higher inflation rate, the rates will go from 40 to 50, 50 to 60, 60 to 70. Today we are around 80, 85. It will go eventually to around 90 and so on. So what will happen is, generally, if indeed borrowing in the US was effectively cheaper, why are even Indians borrowing in India from SBI and HDFC? Because we are worried that if I borrow in the US, when the rate is, for example, 80 rupees, I borrow $100 million, when the rate is 80 rupees a dollar, when I go to repay it, the rate might be 90, 95 rupees, and hence I will have to repay 100. When I got 100 million into 80, that is 8,000, I will have to repay 100 million into, let's say, 90 or 95, that is 9,500, and hence possibly what I saved in the form of a lower interest payment, I will compensate in the form of a higher exchange rate payment. So where are we going? AS16 believes that when there is, let us say, exchange differences, a part of these exchange differences are due to the interest adjustments. So what you save in the form of interest, you will compensate in the form of exchange rate, and hence some part of this exchange differences, AS16 says, would be hidden borrowing cost. Now how to find that is what we are going to discuss over here. I'll again repeat, the logic over here is, if I were to borrow in the US, and we'll come to this using one question and then we will try another question as well. So we will take this question, the homework question 4, as an example, and then go to another question which you can possibly pause and try on your own as well. So over here, we're trying to say that we were taking a borrowing in the US. So let's say question number 4, Raj and company has taken a loan of $20,000 at the beginning of the financial year for a specific project at an interest rate of 6%. So that means 20,000 into 6%, that will come to, let us say, interest of $1,200. But when is interest paid? Typically at the end of the year. 6% per annum, payable annually. On the day of taking the loan, the exchange rate between the currencies was 48, and the exchange rate at the closing, at the end of the year, was rupees 50. Okay, so that is the changes in exchange rate. The corresponding amount could have been borrowed by a company in Indian rupees at a rate of 11% per annum. This is the Indian currency rate. Show the treatment of borrowing costs in the books of accounts. So over here, what I will first do is, I will first try to find the actual interest that I am paying. This is the actual interest that I am paying. Over here, this is $20,000 into 6%. That is, I am paying probably $1,200. But when is the interest paid? Usually the loan is taken at the start of the year, interest is paid at the end of the year. And what is the rate at the end of the year? Around rupees 50 per dollar. AS11 tells you that you will take the exchange rate prevailing on the date of the transaction. Transaction is happening at the end of the year, and hence you will be paying, for example, rupees, I think 60,000 if I am not wrong. 1,200 into 50 will be 60,000. So this will be, let's say, rupees 60,000. That is my actual interest. This should be capitalized if I am incurring this for a qualifying asset. Then I go to the notional interest. Now what is the notional interest? Well, the notional interest over here would be that had I taken this loan in India, well, I'm actually taking the loan in the US, but by the way, had I taken this in India, how much would be the rupee amount? Well, $20,000 into, when I took the loan, the rate was rupees 48 per dollar. And hence, had I taken the loan in India, I would have taken a loan of rupees 9,60,000, and hence into 11%, which would be the rate in India, I would have paid rupees 96,000 as interest. So over here, I'm not 96,000, 9,60,000 into 11%, 1,05,600. So over here, I'm apparently paying 60,000. Had I taken the loan in India, I would have paid 1,55,600. So apparently I'm saving interest. This is called as interest adjustment. AS16 believes that a part of this would be compensated through exchange differences. So over here, point 3, I will say the interest adjustment. Interest adjustment would be rupees 1,05,600 minus rupees 60,000, and hence this comes to possibly 45,600. So I'm saying that possibly I am saving 45,600 in the form of interest. However, accepted exchange rate theories tell you that what I save in interest, maybe I will compensate through exchange differences. So I'll sit and calculate the exchange loss. So the exchange loss over here would be, well, this loan is a monetary liability which I had taken at 48. Now the rate is 50, and hence there is a difference of 2 rupees per dollar for $20,000, and hence there's a 40,000 rupees exchange rate loss. Now when I calculate this 40,000 rupees, let us say exchange rate loss, what does AS16 say? Exchange differences, that is 40,000, to the extent they are treated as adjustment to interest cost. Let us say in this case 45,600. So we are saying that today we are paying 40,000 more because of exchange differences, but at one hand we are saving 45,600. So this excess what we are paying is attributable to the interest savings, and hence we will select lower of the two. So over here, if I had to select lower of the two as hidden borrowing cost, I will say in point number 5, my borrowing cost would be the lower of the exchange difference, that is 40,000, or the interest saving, that is 45,600, and hence the lower of the two is 40,000. So entire 40,000 is attributable to exchange differences, which is borrowing cost only. There's no further forex loss. So if I had to pass an entry, usually for remeasuring loans, my monetary liabilities, my entry would have been forex loss account debit, which goes to the P&L, to loan, which will usually be at 40,000. Here instead of, so you have to credit the loan at 40,000, but instead of debiting forex loss, I will debit the borrowing cost by 40,000, and this borrowing cost, if it is attributable to a qualifying asset, I will capitalize. Okay, and hence my total borrowing cost would be, well, in step 1 I'm actually paying 60,000, which if it is for a qualifying asset you should capitalize, and in step 5 I'm saying that I'm incurring certain exchange differences of 40,000, they are attributable to interest, and hence 1 lakh will be my total adjustment. It's a little complicated. If you understand it, great. Otherwise, just remember these steps. What we have tried to do is we have tried to summarize this using steps. First, you will calculate actual interest, that is dollar loan into the dollar interest rate into the closing rate. This is basically the rate when the interest is paid. Typical interest is paid at the end of the year, and hence the closing rate. Second, notional interest if the borrowing was taken in India, that is based on the actual dollar loan, $20,000, into the rate of 48 when the loan was actually taken. So this is 9,60,000 into the Indian ROI, and then the difference between 2 and 1, that is 1,05,600 minus 60,000 is your interest saving. However, it is not necessary that what you save entirely is what you have to pay. So we will compare this with the exchange loss, which is a closing rate of 50 minus the 48 rate into $20,000. So this will come to, let us say, 40,000. So I will say that exchange loss is having a borrowing cost which is a lower of the exchange loss, which is possibly 40,000, or interest adjustment, which is 45,600 interest savings, and hence lower of the two. There's no other loss beyond this. The entire 40,000 is attributed to interest. It might have happened that your forex loss was, let's say if the rates were around 52 or 53, let's say the forex loss would have been 60,000 or 70,000, in which case we will say that your out of your total forex loss of 70,000, 45,600 is attributed to interest savings. The remaining, if any, is actual genuine foreign exchange loss, which will go to the P&L account. So your total borrowing cost will be the actual in step 1, this is 60,000, plus the borrowing cost element in step 5, which is maybe 40,000, and hence 1 lakh. Remember, all of this will be done if I am following usual AS11. There is a special clause in AS11 called as para 46A. In that, if you follow para 46A, and that can be done only if the question specifically tells you, in case you follow para 46A, this is a loan for a specific fixed asset, then whatever is the foreign exchange gain or loss in para 46A will always go to the fixed asset. So you don't have to do any of these steps. If para 46A is followed, then whether it is a qualifying asset or not a qualifying asset, every foreign exchange loss will be adjusted against the fixed asset if it is a specific loan or an account called as FCMITDA, which is a general purpose loan. This is what is para 46A. Usually if these questions come in AS16, it will not be para 46A unless given otherwise. It will be the default AS11 working that you will have to do. So it's a little complicated this, but it's not worth that you don't do this, because there's an interplay between AS11 and AS16. So institute can possibly ask you this. So you will go to question number 10. We'll quickly discuss this. If you want, just pause the video and try this on your own. If possible, I would strongly recommend that follow these steps that we had discussed. Step 1, actual interest. Step 2, notional interest. Step 3, interest savings. Step 4, exchange loss. Step 5, hidden borrowing cost, which is the lower of exchange loss or interest saving, and the balancing figure, if any, will be the forex loss. Okay, let us try this. Shan Builders has borrowed $10 lakh at the beginning of the financial year for its project at 4%, which means in step number 1, if you calculate your actual interest, $10 lakh into 4% will come to $40,000. Interest is payable at the end of the financial year. At the time of availment, the exchange rate was 56 and at the rate on 31st March was 62, which means when I pay the interest, the rate is 62 and hence 40,000 into 62 will come to around 24.8 lakhs is my interest. If Shan Builder had borrowed this loan in India, in Indian rupee equivalent, the pricing would have been 10.5%. But if I had borrowed the loan in India, this would have been $10 lakh at the rate of rupees 56 per dollar when the loan was taken. So this is 560 lakhs at the rate of 10.5%. So this is 560 lakhs or 5.6 crores into 10.5% comes to around 58.8 lakhs. So had I taken the loan in India, I would have paid 58.8 lakhs. But because I'm taking the loan in the US, I'm paying 24.8 lakhs and hence apparently I'm saying saving 34 lakhs. So my interest adjustment would be the difference between the two, which is 34 lakhs. I'm taking the difference between these two. However, well, do I actually pay this? Well, it depends on what my exchange loss is. So if I go to see my exchange difference, my rate is rupees 62 per dollar. When the loan was taken, the rate was rupees 56 per dollar. Remember, the loan is a monetary item and I have to show this at the closing rate. And hence, this will be a rupees 60 lakhs loss. So I will say that out of the 60 lakh loss, how much is the hidden borrowing cost? Well, it is the lower of 60 lakhs or interest saving, that is 34 lakhs, lower of the two. However, so I will say that out of 60 lakhs, 34 lakhs is due to interest. That means the remaining, I think 60 minus 34 will come to actual foreign exchange loss. So if I had to pass the entry only for this step 5, my entry would have been borrowing cost account debit 34 lakhs, forex loss account debit, which will go to the PNL of 26 lakhs to loan of 60 lakhs, and then borrowing cost, if it is for a qualifying asset, will be capitalized. Then how much will be capitalized? In step number 5, I will take the actual interest, that is 24.8 that I am paying plus 34, which is equal to 58.8. This is the interest that I will capitalize. So over here we can see at the end 58.8 lakhs would be considered as the total borrowing cost as per AS 16. And that, my friends, takes care of this fairly complicated standard of AS 16. I hope you have got a decent enough understanding of this standard. I'll see you soon with another standard. Till then, keep studying, work hard and take care. Good luck.